But our next guest says you just can't sit on the sidelines during this volatility because yields on cash are negative, and a market high does not mean a market top. Joining us now, Emily Rubin, financial advisor at UBS Global Wealth Management. Emily, good to see you. You heard the Fed governor there saying that interest rates are likely to go up a few times. You think it's unlikely that the Fed raises rates in the first quarter?
Yeah, we actually think that the Fed, they're unlikely to take an aggressive inflation-fighting stance right away. We expect them to want to see how the economy looks as the pandemic continues, hopefully subsides, and also to see what it looks like after the taper is complete, which is now expected to be mid-March. So, we're not expecting an increase in Q1, but certainly, as we get closer to the second half of the year, the market is already pricing in 4 rate increases. It seems like it was originally May. It seems like it might be getting a little bit earlier, closer to March at this point. But the fact that the market already has that price in, we feel like that will help mute some of the market reaction if the Fed does make further announcements.
You know, there are lots of interesting things in my notes that you told our producers. One was that a market high does not mean a market top. I get that. I think you're also in the camp that says right now cash is trash. But if I'm leery of where the market is, should I continue to invest at these market highs, albeit not market tops? Should I continue to invest at market highs? And what does history tell us about the returns I might expect if I do invest at market highs?
Absolutely. I mean, as you said, a market high is not a peak. A peak implies that there is going to be a big decline. A market high is much, much more common. If you actually look back at data since 1945, the S&P closed at an all-time high nearly 1/3 of the time. So that's pretty frequent. And investors who put their money in at those highs, more than 60% of them never saw a decline from the starting point of more than 5%. So it shouldn't be scary to put your money in at a high, but I understand where people are coming from. We have a lot of entrepreneur clients who had recent liquidity events. They have a lot of risk in their business, and they want to be more cautious in their investment approach. Nobody wants to be the person who puts all their money in at a market high, and then we have March 2020 hitting us.
Well,
so you have to be.
Go ahead, finish your thought. I'm sorry. Finish your thought, please, Emily. I'm sorry.
You have to be a little more cautious and think about how you're going to go in, but it's maybe more of a psychological decision than a financial one.
Well, maybe I want to get to areas where you think I might sort of splice in some money. But before I do that, maybe I misread it, but I sort of took away from my notes that you are not a full-throated backer of dollar cost averaging. Did I get that right?
No, you're absolutely right. History will tell you that dollar cost averaging doesn't work. Going in as a lump sum outperforms 80% of the time. And that makes sense because the market goes up more than it goes down over time. So like I said, if you do dollar cost average, I think it's a great way to tip into the market and to go in slowly. But it is more of a psychological decision. History doesn't show you that that's going to have the best financial outcome. But we want our clients to sleep well at night. It's not always about the best financial return.
So for that
negative real yields,
for that entrepreneur who you just mentioned, who's had a liquidity event, they sold their business, you would counsel them if they've got, let's say, $10 million to put to work. You'd say, go, put it in now, all at once?
Well, I think you have to take into account, I don't want to be the one suggesting they put it in all at once either. History will say that they should. But again, you have to be a bit more cautious. If you have your life savings, you just worked and sold your company, you want to be a bit more cautious in your approach and go in a bit more slowly. But it's a trade-off between likely financial returns and being able to sleep.